All right, well, let's get into it. The Fed
right.
met this week. There's a lot to unpack, and so let's get started. Let's first off watch this little clip from your Uncle Jerome, and then we'll dive in.
Let me say this: it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go.
So, what are your thoughts on that piece?
So I have a couple thoughts. So number one, just so for everybody watching this, I'm sure you were glued to your TV for the 2:30 press conference on Wednesday for the Federal Reserve to explain why they're doing what they're doing. Yeah. So the whole
I'm
gist
sure
of
they
this,
were.
though,
I'm sure they were glued.
Yeah, I mean, why? What else are you doing on a Wednesday at 2:30? But the one thing with Jerome Powell, so he read a statement that they raised rates 0.75%, 0.75.
Yep.
And he read a statement from the Fed, and the markets went crazy. They were like, "This is awesome." They were talking about meeting and possibly pivoting and going to a slower pace of raising rates. And then this statement right here literally crashed the stock market. Interest rates, that market fell out from underneath it. And I think what he's doing, in my opinion, is he's trying to temper the party a little bit.
Yeah.
Like, I think that he doesn't want the stock market to rally and the housing market to rally and all these things to start rallying based on him saying like, hey, we're going to change the direction, not the direction. I shouldn't say direction, but like the trajectory. Right. And then everybody was really, really waiting, kind of hanging on him saying the word pivot. So he addresses it right here. And this is when he really ruined everybody's breakfast. Right. And he just kind of,
I like when you say he pissed in our Cheerios. I like that better.
I was trying to keep it clean. I don't know how many kids are into this stuff, but he did. He pissed in everybody's Cheerios when he came out and said, we are. So right here, he's saying the next meeting or the meeting after that, we are going to probably look at changing the trajectory of how much we raise rates. And then he goes on to say, we are still a really long way away from, which again, I think is him tempering that it did the markets no good. But it kind of reinforces his stand like, hey, I am going to hammer inflation at all costs. Like,
absolutely.
I don't care.
So much so that at the end of the press conference, and I don't know if we've got a clip of it or not, but he's like, I would rather overdo it.
Yeah, 100%.
Than underdo it. If I'm going to err on a side of caution, it's going to be on overdoing it.
Yeah.
And that's, I think, the part where the market's just like, again, their Cheerios got that urinated in.
Yeah, they pissed in their Cheerios. Right?
So let's watch this next piece and what he says, and then we'll unpack it.
Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned.
So, yeah, I mean, he doesn't...
Political response.
Yeah, I was just going to say the same thing. I mean, he doesn't really get into it. I mean, he is deflecting at best, right? It's like just being so vague, really beating around the bush on the plan. Go ahead.
Right. And that, again, it leads into my belief that he's the Fed chief, right? And the last thing, like, this guy does not want a party. You can tell by looking at him, he is not a party animal, and he does not, the way he's looking at these markets, like the Fed's goal is to bring inflation down to 2%, and they will do it. What I call it the Donkey Kong, right? Or King Kong, or whoever that guy is.
Just a wake of destruction.
He's just going to walk. They're not going to look at anything they're going to do. They're only going to look at these lagging indicators. But the thing is that inflation is 100% what they're looking at. So as these inflation reports come out, they continue to show inflation decreasing or the rate at which inflation is changing year over year, that does drive their decision. They're not going to say they could never say it's only based on the consumer price index or the personal consumption expenditures, or he's never going to list like a dedicated report or number that they're going to base everything on, because their job, remember, is to manage inflation and manage employment.
Yeah.
So they've got to have that balance without crashing either one of those. The problem is when you have so many markets riding on it, and then he just comes out with like a complete nonsense answer. It's just like, well, if you're the one driving the ship, what are you basing it on?
Yeah.
Especially with his track record at not doing a very good job of managing monetary policy in the past.
Yeah, and that's what the reporters kept asking, is like, well, how are you going to know? Like, and they were looking for some type of specificity that he just danced around. There is, however, a big report that comes out on November 10th. I want to talk about that.
He's basing it on?
Yeah.
I know it because
bullshit?
So you have kids, right?
Yeah.
So your girls are what, 13 and 11?
Yeah.
Like the ones that, and then your younger one, mine are about the same age.
Yep.
He's gonna check the vibe.
Yeah, that's true.
If it's
That's
not inflation vibes, he's gonna be like, all right, maybe we'll change things, or maybe we'll change our timeline. But if it's high inflation vibes, then it's going up. So it's just vibes.
Yeah, you're right. And to be fair, I mean, there are there's a lot of things. There's a lot of unknown that can happen that, to I guess his point, can impact what happens next that we don't know. We don't know. However, talk about for just a second, Steve, the report, the CPI report that comes out November 10th, and the impact that can have on things.
Right. So that's the one, and we talk about it a lot, and I think on the last couple of videos we've showed the chart where we're replacing numbers.
Sure.
Right. And what he mentioned here in that report plays really well into this response is he wants meaningful decreases in inflation. And if you look at that chart, we're going to start replacing like a nice string of 6 or 7 months in a row where we could see inflation coming down 0.4, 0.5, 0.6% that each one of those months. So in the next 6 months, there's a possibility that we could see, and look, I'm not predicting. You never know.
Yeah,
like,
it has to come
crazy,
down. I mean, the thing is,
but that would be an inflation decrease of 3%. So if you think about it, right, and I don't want to go way into the weeds here. So if I do,
that's all right.
Rescue
Weed
them.
away.
Don't rescue me. I like it there. I want to stay there, but rescue them.
Fair enough.
But basically, they talk about a real interest rate, right?
Yeah.
So like right now it's considered a negative rate environment because the rate of inflation is exceeding the interest rates, right? So if interest rate is 4% and inflation is 8.2%, it's negative, right?
Right.
So if you're looking at raising rates and they want to get into an environment where they're at a real interest rate, where you're actually gaining interest and not losing it to inflation, it's the teeter-totter, right? So if they raise rates in the next 3 meetings 0.5%, now we're at 5.5% for inflation. And during that 6 or 7 months,
Fed's rate, 5.5 Fed rate,
Fed funds rate. And then during that time, we see some meaningful decreases in inflation.
That
could be 6 months down the road. We're now like, hey, maybe we're tipping the scales. Is that the meaningful vibe that he's looking for?
Got it.
Maybe.
Yeah, that's a great point.
So that's the data that you kind of watch, and that, and again, based on you never know.
Yeah.
Right? But based on my experience, like that data set is what is guiding him ultimately.
Yeah, and the question I think a lot of people are speculating on is, we understand what's happening now. The question is, what is going to happen?
Right.
And that's where you and I have made it very clear our position that once some of these reports start to come out, because we haven't seen any evidence of inflation coming down, that's why it's been so doom and gloom.
Right.
So that's why people are like, mortgage rates are going to go to 9, 10, 12%. We believe that in the next couple of months, we will start to see inflation come down.
Right.
You agree with that?
And he mentions that. He says we are already seeing consumer spending slowing down. Here's the problem is that, and this goes back to what these massive stimulus packages and some of their quantitative easing that the Fed did, is that consumers have, not only do we have record amounts of credit card debt, we also have record amounts of savings. So Powell's position and the Federal Reserve's position is, hey, we can handle some of these prices because people have savings. Now, we've talked about this before. I think there's a lot of people out there that would much rather carry a credit card at, even if it's at 22% or 26%, at $20,000 and have $20,000 in the bank not making any interest because they know that recession's coming.
Yeah.
That people, I think, are going to continue to hammer those credit cards and keep that money in the bank. And again, it's like foresight and hindsight. Is that right?
Yeah, you got that right.
That's pretty good.
That's pretty good.
So like looking back, like, hey, these people have all this money in the bank, but looking back in 6 months from now, what are we going to, like, what kind of position are people going to be in with their debt?
Right.
You know? And that's a scary thing. Now, the bright side is we're still riding on a boatload of equity, and the housing market's still showing a lot of stability.
Mm-hmm.
You know, like we're anti-crashers.
Yeah.
And so there's still a lot of stability there. So, you know, and being in the mortgage business, like everybody's like, they're never like, I'm getting out of the business. Everybody got 2%.
Yeah.
They're never going to refi again. I'm like, man, are you kidding me? Like they just paid off $50,000 in credit card debt with that refinance. You know what's going to happen in 2 years? Like,
yeah.
Habits are hard. You know, old habits die hard, you know? And so it'll be interesting to see.
Well, so further into the press conference, Jerome Powell talks specifically about the housing market. Take a listen to this.
Sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, you know, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. You know, I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. You know, from a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that's really where a very big effect of our policies is.
So the thing that he brings up here that when I think about this, I don't have any issue with what he said, because you see a lot of the doom and gloom housing market fear mongers that we've been talking about. They look at the last 2 years of data of the 35-40% increase in home value, and that being erased.
Right.
Fine. You know, because it was, and I talk a lot about, you know, statistical anomalies.
Yeah.
Even if you erase that and pretend like the pandemic never happened, which it did, and you erase that and we go back to a normal real estate market of, we look at 4 or 5% of appreciation. If you erase 40% of the gain, which I don't think that's even going to happen.
Right.
I think that it's very realistic to say a 10, 15, maybe even a 20% housing market correction, which again, if you play it off the percentages, you can position that information like a crash.
Right.
But if you look at the numbers and you say, okay, from 2019 to 2023, if we do go through a 20% correction, we're still in a net positive gain.
We're in like April of 21.
That's right. That is exactly right. You know,
which nobody in April of 21 was saying these values are terrible.
No.
So it brings up a really good point. He brings up the supply and demand. And
yeah.
Again, it's important. And we see people all the time that say like foreclosures are going to create supply. And it's like, well, first of all, foreclosures are at rock bottom. He talks in this about how tight credit underwriting is. And there's really even, I mean, you almost can't foreclose unless you try.
Right.
You know, like there's people are not overfinanced. You've got to have down payments.
Great equity positions.
Great. That's what I mean. Great equity positions. And there are so many people out there that will buy people out of homes to get into their homes. So like whether it's like investors, like there's a whole segment of the market that lives on that, right?
Yeah.
And that is not bringing supply to the market. That's satisfying one section of the market that has really high demand. Like how many land and property developers do you know that are like chomping at the bit that are calling like we pay cash for houses?
Oh my gosh, it's insane.
Absentee owners and doing all those things to buy these. There's a huge market for that. That is not supply.
So what you're saying is let's just unpack that for a second.
Yeah.
What you're saying is, let's pretend that unemployment becomes an issue, which based on this morning, we could talk about that too in a second.
Sure.
But let's pretend like we get into a situation where people are losing their jobs and they can't afford their homes, right? That's the big headline. That if that happens, that inventory floods the market, and that's what causes inventory to go up and home prices to go down. Fine.
Yeah.
But the thing that's different now, to I think what you're saying, is even if somebody is in that situation, because of the equity position based on the last 2 years, they could still give the home away, so to speak.
Yep.
They could take market value, subtract 10%, and they would have a line out their front door to buy that house.
Yeah, 100%.
Because there's such a huge marketplace for that, myself included.
Right.
So my wife and I, we sold all of our investment properties. I don't even think I told you this. As soon as that starts to happen, what I just said, the investors that have been out of the game because this market's been so hot, there's such a market for that even if the person gives the house away 10% less than market value to drive up the demand from people like myself, they're still going to walk away with a great check.
Right.
Even giving the house away. You know what I'm trying to say?
Yeah, and going back to supply and demand, so the family that's living in the house that gives it away, right? That has the line out the door, that family is not disappearing. So they are going to another door to live. That's right. Whether it be to rent or to buy. Right. Which
downsize or whatever.
So that cancels that transaction out. That's not
from
supply.
An inventory standpoint.
From an inventory, like a supply and demand perspective, somebody foreclosing their house does not add to the inventory or add to the supply side of homes because that family now has to go somewhere else. Yeah. That's what everybody meant. Like, all these foreclosures are going to come on the market. Like, where do you think all those families are going to go? Yeah. Investors like you are going to buy that house at a discount. You're going to make it look presentable. And then guess what you're going to do?
Put another family in there.
You're going to put family in there because now that's a rental home.
That's right.
You know what I mean? So it's that part of it is, again, it's lost. Yeah. Right. It's just lost. And I had another really good point while you were talking. I was all into it.
Well, while you're thinking about that, I can't remember what it was. Why don't we get into mortgage rates? Yeah. And show people.
I'm going to commit the sin and move.
Yeah.
I probably, if I get
get in here. Yeah, but the thing is, before I show this again, I just show the audience. I'm going to come back to in a second. What we're about to show the audience is no emotion. This is the market. Yeah. Like you cannot
data.
You can't like debate this. You know what I mean? This isn't like a graph we made, right? So let's get into this. So Steve, why don't you kind of walk the audience through what's happening on this graph and what's happening with rates in real time?
Right. I'm sure people watching this, maybe you recognize it, maybe you don't. So this is MBS Highway. This is our guy, Barry Habib's website. And again, this is just his data tracking of mortgage-backed security prices. So I'm not going to get into like what the prices mean here other than like rates around here were like high fives.
Which give us time frame. All
right. So that's August, right? Yeah. So that's the end of the summer.
Okay.
High fives, low, mid six, somewhere in there, right? Okay. And then we got down here. This was when rates for the first time really hit like that 7% number, right? Yep. And then you'll see we had some bad days in here. We went down this far. This was on this is when I had man flu.
Oh, that's right.
So
is that what got you sick? Was that day in pricing?
No, it was food poisoning. I'm pretty sure because I don't get sick. But I forget. I can't remember exactly how we ended up with. It was the CPI report. So this was our last CPI report, which came in.
That hurt us.
Yeah, it came in bad, right? And so you can see the rates dropped like a rock, right? Yep. And then you'll see as the market starts to digest the data, like, okay, it's not that bad. And then again, we just got into this run where like all the inflation data was just kept piling up against us saying like, hey, this is like things are going badly, right? Yep. And then you come to October 21st, and this is when the first inkling came out. I think it was a senator in Ohio said, hey, Jay Powell, like, we got to change something. Like, you're raising these rates at such a fast pace. Like, if you started to think about a pivot, and this is how the market responded, right? So we look at trend lines. And so we're on a pretty nice run. We started to see rates come back down here. I mean, we were in like the mid 6 range right around here, which was we had some, like, we locked a good amount of loans in there. And then you come back to Jerome Powell, I think. So is this Wednesday?
Right there in the second. That's the day of the meeting right there.
So this right here is preparing for the meeting.
Yeah.
And then you have the meeting, right? And that's when Jerome Powell.
That's when the urination started.
Everybody got their Cheerios pissed in. And then this was the next day. Again, it's just the market recovery.
That was yesterday.
Digesting information. It actually recovered pretty nicely. And you can see today, green is good. So we're up 27 basis points in the mortgage-backed security markets, which in pricing, that would be like a quarter point, right? So that's $250 better on every $100,000 loan. So one thing on here, and I know you're going to something else, and I'll be quick. So we watch this line a lot, right? Mm-hmm. So this is a 25-day moving average. You can see we really got close to being able to bite above it. But rates, as soon as they get super far from it, they drag back up to that because that's just a trading line that determines what prices these things sell at. And if you compare that to the same thing, so this is your 10-year treasury.
Yeah.
It does the same thing. Look, here's their 25-day moving average, and it just refuses to go below it. Every time it gets far away, it comes back to it, right? So it tends to follow this line.
Right.
But it would not break through this thing, which is kind of an interesting number.
Yeah. So, I mean, the question...
Wake up. Come back.
Yeah, no. The question is, that was great. Thank you for that. We'll probably show that more often because there's still so many people that think mortgage rates will continue to go up as a result of these Fed increases, which they probably will. Yeah, short term. I want to talk about this. And then, your boy PBD on his podcast is talking about, mortgage rates again. And we're going to talk about that in a second. But they probably will go up, mortgage rates, because of what's happening, because things, I like how you put this, they're going to be rocky for probably another 60, 90 days maybe, until what we talked about before, until we have data. Right. Factual data that inflation is in fact coming down.
Right.
So kind of walk us through what do you think that time frame looks like and how long things will be rocky for and what your prediction on mortgage rates will be over the next 60 to 90 days.
Yeah, so it's really going to depend on, we're going to get a report next week. That's a big one. So if that comes in, we talk about 10%, 9%, 10% rates. Like if that consumer price index report next week comes in high, way above expectations, then we'll have, that's when we're really going to see a spike in rates. But what you have to understand is that what the Fed is doing, they've never raised rates 0.75% 4 times in a row.
Sure.
Right. The spread between a mortgage-backed security and a 10-year treasury is the highest it's ever been. Because that market knows that these mortgage rates are not going to last. They know that that these are all going to get refinanced. There's the value of a mortgage-backed security right now is very low. That's why they keep raising these rates. That market is driven by inflation, and the Fed is throwing the entire kitchen sink at inflation right now. Yeah. Right. And so, at some point, we will see it break. There's just
absolutely
they're telling us it is going to break.
Yeah.
Is there a wide channel for interest rates to go up and down right now and stay around this number? Yeah, absolutely. Could we see, the average rates be 7.5%? Possibly. But the thing is, the average interest rate today is like 7, according to Freddie Mac, is like 7.1%. It's not 8%. It's not 9%.
Yeah.
Then you have to think the Fed has gone from 0% to 4%. They've raised interest rates up the Fed funds rate to 4%.
In 1 year.
In 1 year, interest rates have gone from 3% to 7%. Like the largest increases we've ever had. For them to continue at that trajectory, it would be an anomaly.
Yeah.
Right. For it to continue that way.
So I guess my question is, the Fed's going to meet again in December.
Yes.
Then they don't meet again until February.
Right.
I guess my question for you specifically, and I just want your honest assessment on this, not a political positioning answer, between, call it right now, November 2022 and February 2023, that gap of time, maybe interest rates continue to go up, or do you think that potentially they could come back down? Because I am of the belief that later in 2023, when we have absolute concrete evidence that rates do fall back into the fives.
Yeah.
But the question is, between right now, because that's the argument that a lot of people make, between right now and February, what do you think is going to happen with mortgage rates?
So it's a good question. I personally believe that we are going to start seeing inflation easing, and that will bring interest rates down. I think that the next couple of weeks, and maybe even until that December 5th meeting, it's going to be, the markets are going to be driven by emotion, right? It's going to be traders.
Absolutely.
There's not going to be a Fed saying we're doing this or we're doing that. There's not going to be that concrete action.
Yeah.
So it's going to be market driven. If the markets see these inflation numbers coming down, interest rates, we will start to see them ease. Now, it's important to know, like you and I predicted, maybe rates are below 5%. We showed Barry says rates are below 5%. As soon as we see inflation ease 0.5% year over year, does not mean interest rates are going to fall through the floor.
Right.
Interest rates may have a really good day. They may have 2 or 3 days that are really good. And then there could be another report that spooks them and they go back up. It's going to be that bumpy road right now. But I think that inflation has peaked. And I do think that we're going to start to see more of what the Fed is doing impacting the markets. And I think we are going to start to see interest rates easing. So they go up a little bit, maybe, but it's not going to be these giant swings. I think we've done that. I think that part of the pain is done.
Okay.
Now it's going to be a little bit rocky and hopefully going toward the easing.
So if you write a 30-year fixed mortgage today, not to get into the weeds and all your disclaimers and all your stuff, the average, to your point, is about 7.25. Is that fair?
Yeah. I mean, you were sitting here. I just did an FHA
Oh yeah, you just priced out a loan
at 6.8%.
Okay.
So that was somebody with a 660 credit score.
Yeah.
3.5 down on an FHA loan was 6.8%. I did conventional loan yesterday on like a first-time buyer program, and we did their loan at like 6.875.
Okay. Now, fast forward 30 days. The question is, at the end of the year, when you're at my house for our New Year's party, you price out a loan in my office at my house. What is the interest rate? What do you think it's going to be? That's what I'm asking.
Oh, why didn't you just ask me that?
Hey, I'm trying to get
thought you wanted me to talk more.
You've been all political.
All right.
You've
I'm
been
not
like
political.
You're like Uncle Powell, just kind of dancing around. No, I'm just kidding.
I'm watching Boardwalk Empire, so I'm all about
It's not even that
now.
good.
Shaking hands.
You're
lying.
I'll try again, but I tried it.
I don't know what you want.
I know. I'm hard
not
to
everything's
please.
Top Gun.
Yeah, true. So what I'm asking listen,
yeah.
I'm gonna pump your tires for a second,
Yeah.
but I mean it. You're one of the best, if not the best, mortgage guy in the country.
Thank you.
My question is, what does your gut tell you that if you're pricing out a loan, at a Christmas party, you feel like rates are going to be higher then or lower than what they are right now?
Lower.
Okay. That's great. Well, let's listen to your boy PBD and let's get into what they're talking about with rates.
You know what confuses me is the following. Those who are delusional because they're in the industry and they're saying that's not going to happen. There's a very big difference between power of positive thinking and not understanding that the paranoid survive. I believe you should read both books simultaneously. Read the book Power of Positive Thinking because it's good to have a positive attitude, but do not be delusional because you're in real estate and mortgages thinking, no, it's not going to happen. A year ago, rates were roughly 2.9%. In May, when Dave Ramsey called it fear porn, rates were at 5%. And today, rates are 7.5% for 30-year interest. And everyone's saying, it's not going to go to 7.5%. Never. What are you talking about? Do you realize from 1981 or 82, I don't know what the year was, for about 9 years straight, interest rates in America were above 10%.
Yep.
Can you pull that up, please? Do you realize this is the part where people are absolutely delusional. Go to the rates I sent you. No, it was one that just showed the charts. There you go. That's the one.
Yeah, this is Paul Volcker's Endless Halloween.
So check this out. Zoom in so everybody can see it. Let's first look at the first chart to the right, which what we've been used to for the last 20 years. Yeah, go to the right. No, don't worry about the stuff on the left. Okay, so what is it right now? Go a little lower. Okay, 2021, 2.96. 2010, 3.39, 4.5, 3.9, 3.6, 3.8, 4.1, 3.9, 3.6. Oh, rates are cool. This is what we're used to. This is BS. This is a lie. 4.4, 4.6, 5. This is a lie. Then it's real. 6, 6, 6. Keep going. 6.3, 6.4. Go to 2005. Okay, 5.8, 5.8, 5.8. These are numbers that we need to stay around. 6.5, 6.9, 8. Now watch. This is 2000. We're at 8. 7.4, 6.9, 7.6, 7.8, 7.9, 8.3, 7.3. For a straight decade, it's around 7 plus, right? Now you got 1990. Just 32 years ago, it's at 10.13. It'll never crack 10%. It won't happen. Okay, go to 1989. Let's look at 89. Now watch what happens. So that's 2 years, 3 years, 4 years, 5, 6, 7, 8, 9, 10, 11. Keep going. 11, 12. 12 straight years. 30-year fixed rates were above 10%.
Crazy.
Let me say this one more time. For 12 straight years, 30-year mortgage rates were above 10%, and people are saying it's not going to go to 10%.
All right. So hold on. I know you're chomping at the bit. You got to be. So the thing that he doesn't talk about, I mean, he's so passionate about this whole thing right now. But the thing he doesn't talk about is where inflation was at during those period of time. Go ahead. Right. What do you think about that?
So, I mean, that again, inflation was at like 18% or something. I mean, it was like, and we were coming off of an oil crisis. I mean, it was an entirely different time in the world than what we're in right now. We didn't have any of the tools, any of the experience that we've had. And quite frankly, not as much of our economy was driven by housing.
Right.
You know, as when recessions happen in our country, what is the first thing that they do to pull our country out of recessions? Is housing.
Yeah.
The housing employs, I mean, building homes, products for homes, the sale of homes. And you know, saying like you're delusional because you're in the mortgage business or you're in the real estate business.
You're biased.
Like I get it. And maybe I am, but I'm also, I have 20 years of experience in that business and studying and learning those markets and learning these things. And 32 years ago was just such a different time.
Yeah.
To compare it to is wild.
Say it. Don't hold back. You know,
I mean,
so like
it doesn't like, I mean, to compare the economy from, I mean, in the early 80s in that area we were talking about, that was caused by what was happening in the 70s.
So,
you know, which.
Yeah, go ahead. So I mean, go ahead. I want to pull up inflation in, let's just look at an inflation, and I won't be able to show this on screen, but we can talk through it. Because mortgage rates follow inflation. I mean, this is the thing that people, again, I don't know if Patrick's people just aren't telling him this or not, but mortgage interest rates follow inflation. They always have, and they most likely will always do the same thing. So what I want to show people is, let's see, inflation rate chart. All right, so let's go back to this. Historic. This is back to 1914, all right? So check this out. I could have pulled it up on the computer probably. Actually, let's do that. Because we're not in a rush, we're not in a hurry, I'm going to pull this up on my computer. So let's look at this. Because this is the thing I think people are missing. You agree with that?
Yeah, I mean, inflation was 14% in 1980.
Okay, so inflation rate chart. Let's check that out. Historic. All right, so I'm going to pull this up. Here's the good one. All right, so this goes back to what? Oh, that's not the one I want. Let's go back. We can go back to, here, let's go to, this is like the best way to do it, by the way.
Images?
Yeah, because then you can find what you need.
I appreciate that.
Yep. Let's see.
It's hard because inflation's such a hot topic now that there's no
good
datas for it.
Oh, we'll find it.
There we go. What's that first one? Historical inflation rate by year.
1920. Oh, there we go. Okay. Let's pull this up. All right. So this is the thing that, so he talks a lot about, let's go to the
1980s.
1980s. Okay. So right in this wheelhouse is when mortgage rates were I don't know, what did he say they were, 12, 13% or whatever they were.
Like he was talking about 12 years of rates being 10%.
Yeah. Now here's the thing. No one's debating that. What I'm debating in the lack of information being shared is, okay, well, what was inflation?
Right.
What was inflation for that whole entire time? Oh, let's look at that. Let's do the same thing he did. So let's just go back. So you got 8.9, 12.5, 13.2, right? You have inflation that is absolutely much higher than it is now. And again, the argument is the only way rates go up the way that they were in the 80s is if inflation continues to go up. Right. You and I both and many others believe that inflation is on its way down.
Right.
So let me just share this one more time. As inflation goes down, what did mortgage interest rates do? Oh, that's right. They went down. So you can see as inflation went back up right here in 2022, mortgage rates follow inflation.
Right.
So that's the thing that's, I think, taken out of context when he shows, listen, historically, interest rates have been blah, 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 over 10% for 10 years. Yeah, so was inflation.
Right. And part of that, going back to what he was showing is in the Federal Reserve statement, is they want to act swiftly.
Yeah.
And they want to stay on track right now before inflation is entrenched into our
That's
economy,
right.
where you can't bring it down. So they're already on a path to where we're seeing inflation. It's slow, but year over year, it's coming down. Like while some of the numbers are higher than they were last year at this time, overall inflation is coming down.
That's right. And
we're at the very beginning of seeing the impact of what the Fed's actually doing.
Yeah.
So I get where he's coming. Like I get his logic. Like his logic makes sense. And I get that. And I've said it before, you can be an optimist, you can be a pessimist, but the data doesn't suggest that there's going to be sustained rates of 10% for 10 years. Could we get really bad data in 3 weeks and like all this bad news and have rates touch 9 or 10% for a day? Yeah, for sure. But to say it's going to be sustained for 10 years, and I don't think that's even going to happen, by the way, the 9 or 10%.
Sure.
But to say that interest rates are going to be sustained at 10%, it is paranoia.
Yeah, absolutely. So let's we'll do another video when we get some more data that comes out here soon, and we'll just keep our finger on the pulse and keep reporting the facts.
That's right.